Well, hello everyone. In this video, I'm going to spend some time on market movements during the last quarter, and then I'll move on to what happened just after quarter end, which I think you'll agree is big news indeed. Well, in the last quarter, we saw emerging signs of the economic recovery, and this was well supported by continued fiscal and monetary stimulus. At home, the Reserve Bank of New Zealand increased its bond purchases. It also signalled that it might pursue a negative cash rate to lower the cost of borrowing. While encouraging, these initiatives were not unusual in the quarter, with reserve banks in other countries also increasing their stimulus. Growth assets continued their rally, with share markets moving up again. It was the US share market, and in particular large tech companies like Amazon and Apple, who extended their strong performances since March. The result of this positivity was several share markets moved above their pre-crisis high watermarks. This positive mood changed subtly towards the end of the quarter, as rising fears of a second wave outbreak overtook and new lockdowns and restrictions came in place in Europe. Now, given that backdrop, what were the returns that investors achieved? This table depicts the returns of our investment funds over short and long-term periods. You should be able to see that the growth-orientated multi-asset strategies perform strongly. There are two other things that I'd like to highlight. Firstly, following a long-term strategy, being patient and not selling during the crisis has achieved decent and positive returns for investors. Second, you might have noticed that the returns from cash funds are quite modest. With the Reserve Bank of New Zealand continuing to provide monetary stimulus, we expect these low returns to continue or possibly move negative. Let's move on to what's happened since the quarter end. You may well be aware of these topics, so I'll only cover them briefly and then focusing on the investment implications. In local politics, the election went ahead 4 weeks late, and it focused on the key issues of the government's handling of the pandemic and track record in economic management. And with the Labor government achieving a majority position, it should find it a little easier to deliver its policy initiatives. However, the challenge ahead is in addressing unemployment and rebuilding the economy, and this cannot be understated. We think this means significant stimulus continuing from both the Reserve Bank of New Zealand and the government, and this might be needed for an extended period of time. While New Zealand has been very successful in controlling COVID-19, the second lockdown in Auckland during August demonstrated the continuing risk posed by the virus. And then there was the US election, with Joe Biden seemingly likely to win, although the result is disputed by the Trump camp. A Republican-controlled Senate is also likely, which when taken together, we think this combination impacts US politics in a couple of ways. While the election result remains disputed, we think it's challenging for new fiscal stimulus packages to be agreed. That said, the US Fed appears ready to step in and provide support as needed. While this isn't an ideal situation for the American economy, we think the potential for stimulus should continue to be supportive for financial markets both in the US and globally. Secondly, a Democrat president and a Republican Senate makes it very challenging for Joe Biden to push his party's more progressive domestic initiatives, such as tax increases, which were seen quite widely as negative for markets. Lastly, there was positive news from several pharmaceutical companies for the development of their vaccines. While none of the vaccine news received so far should be viewed as the end of the health crisis, it seems probable that a vaccine can be widely available in 2021. So what does this all mean for investors? For the moment, the major risk remains further waves of virus infections and the potential for new lockdowns. With this backdrop, we believe a stronger employment recovery is needed to push share markets much further. Whilst we've seen some incredible employment numbers across Q3, it's hard to envisage smooth growth in all sectors from this point. We think the next few months will involve increased share price volatility. And within fixed interest and cash, it's increasingly hard to see strong returns anytime soon. Whilst these asset classes should provide safety if the economic outlook worsens, investors seeking a higher return may prefer to turn their attention towards more growth-orientated funds.